Welcome to Talk Money with Tom. Really excited today to have everybody join us. And this is a pretty straightforward show. We do a Q&A session. I'll start off with a summary of what I see happening in the market this week. And then if you have questions, you can just send them in to Ask Tom at talkmoneywithtom.com. And Katie, who's here at the bottom, will be our moderator. She'll be the one asking the questions. She might have some follow-up questions. And then Eason is another one of our advisors. He might fill in with some other information or ask a follow-up question. We really try to kind of build out these answers as much as we possibly can so that you can get something. And our big emphasis is on trying to help people build their wealth. And one of the ways to do that is to increase investor education. We focus on financial planning and tax planning and investment management planning, those three main areas in this particular show. So if you are interested in trying to keep up with the videos that we're posting on our channel, you can send us your email to our Ask Tom email address, and we'll put you on our email list, or you can subscribe to the channel, just hitting the subscribe button and then hit the little bell next to that, and you'll start to get notifications when we post. We put a lot of educational content on our channel here also too. So I want to thank everybody for joining us and what have you, and I'd just like to start with a summary about what I saw happen this week as far as that goes. And so this has been a very interesting week in terms of what's going on. And there's a lot of different kind of cross currents that are happening. So let me share my screen and I'll go through those with you. All right, so this is a chart from the New York Times just showing the number of cases here for the virus. And so obviously this is a really big deal. The last 2 weeks, we've had this really big growth in the virus, and you can see that here. And so this is one of the things that really seems to be, looking at what's happening within the market because, we've been working on this reopening piece and everything's going to reopen here. And now maybe the reopening could be slower because of the virus outbreak and what have you. And how does that affect things? I will say a couple different things. This particular trend definitely looks troubling as far as that goes. But if we look back to the time frame that we had here from end of September through January, we ended up with a really big growth in cases as far as that goes. Yet the stock market did quite well in that time frame. So one of the things the Federal Reserve talked about this week, was just that they felt like the economy could still function fairly well inside of this pandemic. And we've gotten better at it and what have you. There'd be certain industries certainly that would be impacted, but a lot of those industries aren't that heavily represented in the stock market. And so the companies, the big companies, the Apples, the Microsofts, the Googles, and what have you, are still able to function fairly well. And the only way that those big companies really start to have trouble is if the overall economy comes down so much that people stop buying, iPhones or whatever it is, and so that's what we kind of want to watch out for, and we'll see, how the government responds to this. But we are seeing a little bit of, vaccine growth still. This is a chart. It basically shows, how many people have had a double vaccination. So we've hit August 5th, we hit 70% for all adults. August 2nd hit at least one shot. But the projection here is interesting. They're saying that by October 2nd, we might be at 70% for the entire population, including kids under 12. That would obviously require us to have that approval at some point in time here fairly soon. Hopefully, soon, because school's about to reopen. So there's a bunch of different cross currents happening there. And again, this is one of the most interesting times I've ever seen. And really, this is a historic time frame. It's very fascinating to see how this will play out. But the vaccine and the virus are definitely a part of the story, especially with the resurgence as far as what's going on there. And then today we had a report. This is one of the most important numbers that come out every single month, is how many new jobs were created. And so this morning, they reported that for July, we had 943,000 new jobs created. And so you can see prior to the pandemic, we had 152 million people working. That dropped all the way down to 130 million. That's a historic drop off, 22 million jobs lost in a very short period of time. And then we've now crawled back up to 146 million. But there are a couple pieces that are really important with this is 943. Number one is it's a really good number, but it's not so good that people are really nervous about, an inflationary environment, because labor is the one key thing that people watch for, and in the inflation, conversation. But we still have 6 million people less working than we did back here, and we didn't have that much inflation here. So we'll see what happens. There's other reasons we might have some inflationary pressure here than just labor. But this is a really important piece. I do see this as a really good number today. Too low, there would have been some concern about, the economy not opening fast enough, not enough people coming out of, out of their homes back into the workforce and what have you. So this is a really significant number today, and it had some impact today, and I'll show you what happened there too. But uh, the other piece has to do with inflation. And so, it's really amazing because there's a group that's saying, hey, that might be reopening too slow because the virus. There's another group saying we might have, a really high inflationary environment. But the one thing I would say is watch the 10-year Treasury yield. And so this blue line here is the yield for the 10-year Treasury over the last 6 months. You can see we hit this big peak back in March and April, and we've basically been coming down. So when the yield comes down, what that's telling you is that the market is feeling like there's less threat of inflation. So that's a big deal. We did see a big jump today, if you see that, just because the job report was pretty good. Maybe that tightens up the job market a little bit, but really the trend is still very much so down. And so the threat of inflation, as far as the bond market is concerned, is relatively minor at this point in time, or at least getting better than it was the thought process back here in February and March when things were really going up. So yeah, that's another piece that we have to look at when we're looking at what's happening with the market. And so far, I think that's doing okay. And that's stimulative to the market, in my opinion. When the rates come down here on the 10-year Treasury, the stock market looks more attractive. Now, here is the stock market. This particular chart shows the total stock market index from Vanguard. And this is the ETF version at the ticker symbols VTI. And so this is essentially all of the stocks in the US stock market. So I really like looking at this. This is the one index that I watch all the time. And this is the last 3 weeks. And every one of these bars is the 10 minutes. And so you can see, these little spaces here are each day. And over the last 3 weeks we had a big drop, one Monday here, and we came back. But look, if you look, we're basically just going sideways the last 2 weeks altogether. Really no motion, lots of news, lots of things happening, but the market's just moving sideways. And I don't think that's a bad thing, because here's one of the things that I am looking at, and that's this chart here. This is the last 1 year. And again, now each one of these bars is a day. And so if you look at this blue line, this is the 200-day moving average. So every point on this line is an average of the previous 200 days. And so one of the things we look at is, where's that going? Well, it's going straight up. That's really, really strong, actually. But one of the things I look at is that there's normally downturns, and they let the pressure off of getting way too overpriced. Sometimes there are big downturns. I don't see that happening, but I do think that there's some room for a smaller downturn. And the last time we had smaller downturns are right here. These were almost 10%. This was September of October of last year. And so it's been a while. And this is kind of, when I talk about stretching the rubber band, we're stretching the rubber band. So one of the ways to let the steam off, though, is to go sideways. So that's why I kind of like what's happening in the last couple of weeks, is just kind of letting things settle a little bit. But if it does pull back, that's not a bad thing either. Because look at what happened when it pulled back in September and October. That created this buying, frenzy, so to speak, and we ended up with this really incredible run from that point in time. So I wouldn't be too worried about it if it does happen. But that's something that we're looking at as far as that goes. And that's not an issue. It's not, hey, the market's falling because everything's falling apart. It's a normal part of the market to settle in and pull back, create some buying and what have you. So we'll see what happens there. Now this is the what we call the nine boxes. So this is just this week, looking at it. And so we've got value and growth, different types of categories and core, and we've got big stocks and little stocks and small companies, etc. And so you can see the biggest winner is the large growth. Again, think Apple, Microsoft, Google, Amazon, etc. But growth as a whole did quite well. That looks just like last year. This particular column right here was the leader last year because these are companies in general that can operate in a virus environment. And so you can see what happened in the last, week. The concern was partly about the virus. And if you look down here, the worst category is the small value. These are the most economically sensitive, and it's also full of reopening stocks that need the virus to kind of go away to really function fully. And so you can see what was happening there. And if you look at the last month, it kind of just confirms. So over the last 30 days, the big stocks have been doing well. When things are, challenging and you don't know where things are going to go, a lot of times the high quality companies with lots of cash flow, those are the ones that get, again, the lowest category was here in that small value. But look what happened today. So today is just the opposite. The numbers came out for employment. They were very good. People are starting to feel better about the reopening possibilities, at least for the day. And we saw that small value really, really moving today. And actually, some sell off here in this category that's been running quite well, as far as that goes. So, this is a reason why you want to be kind of in the broad market. You really want to own all nine of these boxes. And one of the ways to do that is if you take a look at our portfolio, this is our current stock market mixture right now in our traditional model, is to own the total stock market index. So that's our biggest position. And one of the reasons that we have that is because their money is moving around so rapidly. There aren't a lot of trends. And then we also own a big chunk of the S&P 500. Same thing, just own all of that, as far as that goes. And then we have two large, broadly diversified ESG portfolios. And so ESG is kind of interesting. It's environmental, social, and governance. And what they're doing is they're rating companies on those three areas, and they come up with a number. And so Vanguard, if you look at this right here, the Vanguard ESG USA, this ESGV is the ticker symbol. This is the same index. They take the total stock market and they just screen it out for those ESG stocks. And let me tell you why this is working. And here's a chart from Morningstar. This is the amount of money going into sustainable investing since 2009. Look at this chart. This is the most untalked about thing I've ever seen. It's incredible. There is a massive growth in sustainable investing, and it's just going basically straight up. And so that's making those pieces do quite well. And really, there's a lot of interest there. And when money flows into one area, generally speaking, that area has a chance of continuing to gain. And this chart shows that, at least at the moment, it doesn't seem to be slowing down. Matter of fact, the projections are that that could pick up quite a bit. And we actually do have 100% ESG portfolio. So it's got that same, Vanguard ESG US stock piece in it, and several other, pieces. And these are our targeted indexes, including water, which is doing really well. And so essentially what's happening here, this particular portfolio is, all ESG. It's doing quite well, fairly popular within our clientele as far as that goes too. So that's kind of what's happening this week. Really fascinating if you look at, got that cross current of the virus, coming up, creating some potential economic slowdown situations. And then today's report of a really good jobs report coming out is showing a, situation where the reopening could be, still on track as far as that goes. And so, again, all of these things are happening. There's no way to really get onto one trend or another very well this year, in my opinion. I do like the high quality area. I love that right now. I think that's a great area to be because in times of uncertainty, I'd rather own a company like Apple that has, so much cash and so much cash flow. But really, I would like to own all of it, the entire market as far as that goes as much as possible. So anyway, that's what's happening this week. It's a very, very fascinating week. And this is, again, a historic time frame to really see how this is going to play out. So I look forward to kind of talking to you about that again next week. All right, so let's get on to the Q&A section of the show here. And you can, just let me know, Katie, what's our first question?
So right off the bat, we have a question that we weren't able to touch on last week, but a client of ours is asking, have you looked at Coinbase Global, ticker symbol coin? What are your thoughts?
Okay, so Coinbase, went public not too long ago, and they're basically an exchange for cryptocurrencies. And they had a phenomenal IPO that came out of the gate really, really hard. They did fall some after that. The valuation for Coinbase as a cryptocurrency exchange greatly exceeded the valuation for, say, the NASDAQ, which has been around for a really long time. So it was really, really, really hot at one point in time. That would probably concern me a little bit, just from a pure valuation standpoint. When the Coinbase is worth more than an established index, but the future in the area of cryptocurrency is potentially bright. There's an awful lot of interest in cryptocurrencies. I'm not, involved in cryptocurrency in terms of as an investor or as a professional money manager, just because I'd rather try to find the next Amazon or something, that some business that had a product that had something that they were trying to do, the cloud servers, whatever it might be. And because the cryptocurrency arena, there isn't anything I can get my head around in terms of, what's happening. And we do have some, regulations coming in. We have this part of the infrastructure bill. They're trying to, basically get more taxes out of cryptocurrency. The U.S. is talking about their own digital currency. I don't know if that would go through Coinbase or not, as far as that goes. Um, so I think it's one of those things that is I call it a home run investment, and I don't have a problem with trying to hit home runs, but it should be fairly small portion of your portfolio. Uh, and if it works, it doesn't take that much. Again, I always talk about, I have a client that bought, Apple when it looked like it was going to go out of business with 14,000. That's now worth 2.4 million. So that was a home run scenario where, just didn't put a lot in. If it disappeared, they'd lose 14,000, which would hurt. But, that's how I'd probably treat this personally.
So when you invest with home run stocks, do you try and get like one or two and then put it as like a couple percentage of your portfolio? You know, how much should I be risking in trying to, if I'm trying to hit a home run?
Well, I'd say part of that's your personality. How much risk can you take? Are you willing to have that disappear or turn in half? Those type of things. So you have to look at yourself and figure out, what you can handle as far as that goes. Part of it is your age. So, again, if I have, a longer period of time theoretically to let that develop, and maybe cryptocurrency does turn into the next NASDAQ, maybe they find a use for these cryptocurrencies and that really kind of, explodes that market. And so, yeah, I would definitely be thinking something, less than 5% for that whole category, personally. Again, just because of the volatility, and but again, because of that volatility, that, 1, 2, 3, 4, 5%, whatever it might be that you use, could turn into a really big, piece of your puzzle altogether too. So, yeah, I think I'd keep it somewhat limited, but that's just the way I do it.
Now, if I'm a conservative investor, would I still be able to hit a home run, or do you need to be pretty risky with it?
Well, the thing that goes against a conservative investor to a certain degree is that, you know, you could buy something like Coinbase, and I don't remember the exact numbers, but I do believe it dropped pretty dramatically. It went up a bit right after the IPO and then dropped maybe 40, 50%. So let's say you're a conservative investor and you're looking at that, and man, that thing drops 30% and you're really getting nervous, and you end up selling out. And maybe 10 years from now, it's 1,000% higher, right? So that would be the one thing you'd have to think about if you were a conservative investor, is just, can you handle, let's say a 75% drop. Um, and then maybe eventually it does come back, you'd hope, right? But that's what happens, generally speaking, when people get into things that are too aggressive for their own personality. They end up selling, and usually at a low point, right? The other way to kind of cut that back is to just do smaller dollar amounts. So I was talking to a client who has $400 in Bitcoin, okay? And he's putting in $5 a month, right? Well, that's, he's fairly conservative. And so that's different than somebody that's going to put in, $400,000, because just the loss. I mean, if you lost 50% down to, so that's one way. There's two ways. There's percentage and there's dollars, right? And dollars actually probably make more sense to people. So look at it and say, how much would that be down where I'd start to really get nervous in a dollar amount? So if I was to lose $500, okay, then that means you probably can't invest more than 1,000, if that makes sense. If it's going to drop 50%. So think about it from the standpoint of what dollar amount is going to make you panic and sell. And then that kind of tells you what percentage or what dollar amount you can buy based on some expectation for dropping, right? If that makes sense. So yeah, it's a really interesting area. The home runs are, I have no problem with that. I've done lots of them for clients. We carve out pieces of portfolio. If somebody wanted me to buy coin, I have no problem with that. I would generally advise, how much, or, what makes sense. We could look at their financial plan and make sure, if that did disappear, that it would be okay. I just look at that from the standpoint of being careful with the amount that you're going to put in.
So we just had a conversation with a client and they brought up a great question asking, I am 71. I'm going to take my required minimum distributions next year. How does that work?
Yeah. So this is a very common question, because the required minimum distributions are a little bit confusing in total, and they're required. So you turn 72 and you have an IRA or a 401k or a 403b or 457, any type of retirement plan, you must start taking money out of that retirement plan. And if you don't, whatever you were supposed to take out, let's say it was $10,000, and if you didn't do that, the penalty would be 50%, $5,000 penalty. So it's something to be concerned about, is something to ask about, something to learn about as far as that goes. But basically what happens is, let's say in this particular case, the client was 71. And so at the end of this year, the value is what matters. So the last day of this year, so of 2021, whatever the value is that you have in your retirement accounts, that's the first piece of information. And then next year, you'll have basically a calculation that says how much you have to take out. And it's going to be around 4.5%, give or take. And then that grows. And I won't get into all the mechanics of how the calculation works, because that's even more confusing. But let's just say you have to take that 4.5% out. You'll have to take it out next year, 2022 in this case. And you can take it out any time. Even though if your birthday's at a different month, that's not the part that they care about. But you do have to take the money out sometime in 2022, between January 1st of next year and December 31st. That money's got to come out, and then what happens then is it becomes taxable, right? And that's what the government wants. They've allowed you to grow this tax deferred without any taxes on this money, for the most part, for a long time. And now they want to force you to kind of take some income out of that and pay some taxes on it. And one of the things that, there's some other key issues to think about. Also, you can withhold tax. And so, that's kind of nice. You can say, I want to withhold 20% for the feds and 5% for the state. And that way you don't end up, having to write out a check or some kind of penalty for underpayment or what have you, when you do file your tax return. But I do also even have clients who withhold way more, basically because they've got other things that they're not withholding on. And so they use their requirement of distribution, and they'll basically withhold all of it. And it just pays their tax when it comes out, as far as that goes. Another consideration is when you take it out. So let's say you're supposed to take out 25,000, for example, and you take it out January 1st. And let's just say your accounts make 10% next year. You could have made another $2,500 on that if you took it out at the end of the year. And so a lot of my clients who don't need the money wait until really kind of late November, early December to take it out. That just allows, theoretically, that money to make money for as long as possible. Now, it could be a down year, and you could have been better off taking it off at the beginning. But overall, the stock market goes up. And so if you do that year after year after year, you're probably going to make more money. And then you leave that extra money in your account to grow. So that's the timing of the required minimum distribution is somewhat important. The last thing to think about for a required minimum distribution is you are allowed to pay part or all of that out to a charity, and then it doesn't end up on your tax return. And you can only do this with a required minimum distribution. So let's say, for example, you're already giving 5,000 a year to charities. Depending on your situation, you may or may not be getting the write-off for that, because the new charity write-off rules are a little bit different. And so if you then just give it right out of your required minimum distribution, then that 5,000 does not end up on your tax return. So if you needed to take out 25 and you took out 5 for charity and the other 20 you took out yourself, only the 20 ends up on your tax return. And so that's a great way to get the full write-off. Very, very popular. The only criteria is that the charity has to cash the money, the check, uh, before the end of the year, and they need to get the money directly. In other words, you can't get the 25 come out to you, put it in your checking account, and then you pay it. It has to go directly from your IRA, 401k, or what have you, to that charity. And then they have to cash the check before the end of the year. So one of the ways we do that is give people a checkbook against their IRA. And then they're writing that check out for 5,000 to that charity or group of charities. And then that's the same thing. It's just directly going to the charity from your IRA. There's another way to do it too, where we have a form that gets filled out, and then the custodian sends it out. But the checkbook works really, really well. So those are some pretty important considerations to take a look at around required minimum distributions. It's a big tax event and a big event in people's lives. Actually, age 72 is something to think about as far as that goes.
Yeah, and then we can always help you calculate it. And if you've been donating to charities throughout the year, we can tell you at the end of the year how much you still need required to take out, just to make sure you hit all the numbers for yourself.
Yeah, it's important. It's one of the nice services that we do, I think.
So Ethan, we have a question for you asking, how is my Social Security taxed?
So Social Security is taxed based on your combined income, which is your adjusted gross income plus your non-taxable interest. So that's kind of your muni bonds, and then half of your Social Security benefits. And so if you're below 25,000 as a single person or 32,000 as a joint, there's no taxes on your Social Security benefits. If you're between 25,000 and 34,000 single and 32,000 and 44,000 joint, you have half of your Social Security benefits is taxable. And then anything above those numbers is 85% is taxable. So money, you're getting Social Security, which is really nice. And so you still get 15% of it always tax free.
Yeah, that's one of my key points. Actually, no matter how much taxes you're paying on Social Security, it's a government guaranteed pension with a 15% of it's tax free. And so that's pretty cool. It's very, very difficult in today's world for anybody to qualify for tax free Social Security altogether, because they're counting half of your Social Security against you. And of course, Social Security's gotten bigger and bigger, and they've never adjusted. I was doing seminars back in the 90s where those 32,000 and 44 for a couple, for example, were the same numbers. So they haven't adjusted it for inflation. So we did do an example last week where we showed, conversion of retirement accounts into a Roth IRA, and then they were able to live off of those Roth accounts tax free. And that did reduce their Social Security tax to basically zero. So there are some ways of doing it, but it's not easy. But it's a good question.
We have another question that just came in asking, I am in my early 50s. I am maxing out my 401k. Should I save it into an IRA or a brokerage account? I make too much money for a Roth IRA and I wouldn't be able to deduct my contribution to my IRA.
That's a great question, and one of the things that I think is interesting, at least for me, I've done over 6,000 financial plans. I'm working on my 36th year here. Every 6 months we go through a strategy session with clients, and I've been able to see all of these paths that people take, and One of the things that I would say I would encourage people to look at is just the structure. Like, where is the money, the buckets of money that you kind of have? And so for those people that have everything in 401ks and IRAs and those types of things, there's some advantages in the sense that, we can make moves from one area to another in the market with no tax. In today's world, we don't even have commissions, which is kind of nice. But there's also some disadvantages. If you need some lump sum for something, oh, I got to do my foundation, and I need, 50,000 or 75,000. It can be very, taxable because now I'm pulling that out of my IRAs, and it's 100% taxable at ordinary income rates, which can be quite high, versus having some money outside in kind of a regular brokerage account where you got a capital gains tax rate instead of an ordinary capital rate. And then having that other money at the beginning of your retirement to live off of, lowering your taxes, especially, at the beginning, allows you, if you're so inclined, to start converting some of your 401ks or IRAs into Roth IRA. And it gives you just some room within those lower tax brackets to move stuff over. And so I would think in your case that I would be looking at trying to add to a non-retirement account. The brokerage, we call them taxable accounts. There's different names for them, but really trying to get some assets into a different bucket. Now, if you're thinking about retiring early, before 59 and a half, that's even more important because the money coming out of those retirement accounts are penalized before 59 and a half. So if you're going to retire, if you're 50 now and you're going to retire at 55 or hopeful, then you definitely want to build up some assets outside of those retirement accounts so you have something to live off of during that period of time. There are some ways to take money without penalty, called the Rule 72T, out of those retirement accounts. But given the choice, building up some assets outside wouldn't be a bad solution.
So you talked about taxes. If I was to build a brokerage account outside, what's some tax efficient ways I can do it? Should I be just, throwing all my money into an index fund and kind of forgetting about it in a sense?
Yeah, we actually develop specific portfolios for taxable accounts, and they're designed for more broad market exposure so that we don't have to make changes very often. And so you'd want to be in kind of all of the areas. Matter of fact, in my opinion, you want to be very broadly diversified. Maybe you have some targeted pieces that you might move around, but they should be fairly small and fairly infrequent, and you really need to hold on to those for more than a year. It's a very different philosophy of investment, in my opinion, for those areas. But yeah, I actually would be looking at some index, exchange traded funds like that Vanguard Total Stock Market Index that we just looked at. It's very tax efficient. You will pay taxes on dividends, as they're paid out, but the actual holding itself, the exchange traded fund, does not pay out a lot of taxes uncontrollably to you. So it allows you to pick when you want to get those. And so I think that's probably the right strategy. But you need to have a specific portfolio for that type of account, in my opinion.
Now, Tom, let's say I've been married for about 57 years, but 50 years ago, I found out that my husband killed my childhood dog. How would my Social Security benefits affect or change after my divorce?
Yeah, well, in essence, basically, you have to have a for an ex-spouse and Social Security. It's really kind of interesting. If you're married for at least 10 years, basically which you were in this particular case, and you are, of age to get Social Security, which is at least 62, it is essentially like, oh, sorry, one more criteria that's important. You need to be unmarried at this point in time. Um, in fact, you could have remarried and then unmarried again, but you have to be unmarried. And for that situation, you're going to get your Social Security or half of your ex-spouse's Social Security, whichever is higher. And so that's a lot of people don't know that. It doesn't affect the ex-spouse at all. Doesn't change their Social Security payout. But you might be able to get, and I've seen that actually. I've seen situations. I had a case come in where the mother of the clients that were coming in and talk to me was getting a pretty small amount of Social Security, and didn't realize that she could get half of her ex's Social Security, and it was almost double what she was getting. And it was sort of a tight financial situation too, so it made a difference. So she could go down to Social Security and apply for that. And a lot of people don't know that. So otherwise, at the point of divorce, it doesn't make any difference. Actually, what makes more difference is if you're going to remarry. Um, this is very strange, and I've run across this a few times where I've got couples that are living together that aren't getting remarried because one of them has an ex-spouse that has more Social Security than the potential new spouse. And so then, if they don't get remarried, they can collect that. If they do get married, then they would get less Social Security. I don't think that's a great way to look at marriage, but I have actually seen that a few times. But that's, it's an interesting, piece of it.
So could like multiple people have the same like spousal like kind of security benefit if they're or just multiple this guy or say a partner was married to multiple people for 10 years plus and they just never remarried after that.
Yeah. You can have like, let's say you had three exes and they're all unmarried and you're married to them for, at least 10 years each. Then three people can be drawing off of your Social Security. Again, it doesn't affect you. So that's kind of interesting. It's just that's part of the one of the benefits that Social Security has. So yeah, it's there's a lot of very fascinating scenarios in there that in terms of Social Security. We do a whole seminar on Social Security maximization, and that's one of the things that comes up.
Very interesting indeed. Um, will Social Security keep up with the cost of living?
Ooh, well, it's kind of a hot subject right now. Um, because Social Security does have a cost of living increase. It is a special basket that they try to represent for somebody who's a senior. Because, I mean, honestly, as a senior, you might be buying something different than somebody who's 20 years old. In my personal opinion, and the vast majority of my clients' opinions, it's not enough to truly keep up with the cost of living. Social Security's buying power, in their opinion and mine, does deteriorate over a period of time because inflation that you actually have seems to be a little bit higher than what they're doing. But it does grow, which is actually a very significant benefit. To have it grow even, a fraction of the actual inflation is a big deal. I predict that they'll probably take away the cost of living increases on Social Security for some younger age group at some point in time, just to make Social Security still work. But the current people getting Social Security get a cost of living increase. Now, we're hearing rumors that this one that will happen for next year for 2022 um, might be in the 5 to 6% range because we have had a big jump in inflation, and the basket is flashing 5 to 6% increase. So, the increase for 2021 was only 1.3%. So that could be a really big deal. I mean, that's a big jump. I mean, somebody's getting 30,000 a year in Social Security to get, another 1,800 or something a year. That actually really adds up. That'll be very interesting. They announce that in October of every year for what the increase will be for the next year. So, we're not too far from that. It'll be interesting to see what it is.
Does Social Security your benefits ever go down? Say like the cost of living goes down for some sort of, couple of years there's a recession and prices deflate a little bit.
I don't think so. I've never seen that happen. Having said that, we've also never had a significant deflationary environment that we've dealt with. We got close in 2008. There have been periods where it was zero. Matter of fact, there were periods where it was zero for several years in a row, not that long ago. But I don't think it goes down. I'm not positive on that, but that's an interesting piece. That probably is why it went to zero. Essentially, was just as part of the piece there. Social Security is super important. The average retiree over 65 has Social Security plus $49,000 of investment assets. according to the studies I've seen. And so Social Security is critical, and that's why it's kind of a the third rail of politics type thing. Why people are really nervous about talking about any type of cuts or anything along those lines, because it is incredibly important to the retired community as a whole. And even people with a lot of money, it's a very nice benefit. So yeah, I don't think they could get away with cutting it, but obviously, you never know what could happen.
We just got a pretty interesting question in asking, how can I invest like the 1%?
How can I invest like the 1%? So what they're talking about, I suppose, is the top 1% in net worth, the Jeff Bezos and what have you of the world. How do you invest like them? Well, I guess in all honesty, you can't actually to a certain degree. One of the well, okay, I'll give you one example of how you could, but one of the things that does happen for a very wealthy investor is they get into different types of deals that you really can't get into. There might be a $25 million minimum or $100 million minimum or something along those lines for some of these private equity things. And these are probably really interesting investments that have a fairly high degree of success. You're getting in really early, but you're talking, kind of investment banking and the venture capitalists and those types of things. And they're kind of running in a different world that you really can't, unless you're already in that group, you really can't come up with that kind of money. If you have $100 million to plunk into something, then you're already pretty close. So one of the things that might be an area that you could invest like the 1% is think about it. These guys all started businesses, right? Elon Musk and Bezos, and not all of them. Some people inherited their money, but an awful lot of the people that we know about have and started a business, and so that's one way you could invest like the top 1% is getting involved in a business, in the startup of a business, and hope that that works out and that you can kind of grow your wealth that way. That's not the stock and bond market that we usually talk about, but it's the only way I can think of that you can kind of you know um, rotate around as if you're heading for that direction. But it'd have to be a heck of a successful business to really get there. It's not easy.
We got another question in asking, at what point should I get a financial plan?
Oh, yeah, that's kind of interesting. I think the youngest person I've done a financial plan for is 22, and that was no problem. So really, there isn't a low end age or a high end age. You can be 90 and still have a plan, to look at the tax planning standpoint and the different things like that. Really, as soon as you start making income, it wouldn't be a bad idea to have a plan. I think one of the key things of planning for somebody younger isn't so much that the plan would be exactly accurate, 60 years later or whatever, uh, but it's a motivational tool. It'll give you a path. So I'm 22. I want to retire at 50. What do I have to do? What do I have to save? What are my probability of success? What's the issues that I have to deal with? And so, for example, should be saving some money outside of retirement plans because I'm retiring at 50 and I can't get to those retirement plans without a penalty or using 72T until 59 and a half. So I might, so all of these things are motivational. And once you kind of see a path, right, you see, ooh, I can go this direction. I can go down here and try to get somewhere. That's where, that saving start. Because that's what this is. If you can't save, there won't be anything to invest. And then the investments can grow. But you have to be able to save first. You have to be able to put some of that money away. And so, yeah, that's I would say there isn't a too young age. I'd work with anybody personally that at any age, because again, it's just about creating a path, creating a motivation, and creating some place that you want to go.
Yeah, and it gives you that reassurance that you're on the right path, you can make it there. And say you were saving 50% of your income somehow, but you only need to save 30%, and you can use that other 20% to like maybe you're living your life not to the fullest per se. And so being able to cut back that savings a little bit and doing things that you really enjoy. Because in the end of the time, you want to still enjoy your money.
Yeah. But you'd obviously want to revisit the plan on a regular basis. We do it every 6 months, but at some point, that we can make adjustments and you get even more confidence that you're going the right direction. So, yeah, it's a good question. All right. Well, that's the end of today's show. Really thank everybody so much for coming. Again, if you want to subscribe, you can hit the subscribe button. You can send us your email to get on our email list. We'll send you out the emails as far as that goes. But I want to thank everybody so much for coming. Some great questions today. Thank you very much. We'll see you next week.